Kevin McPartland joins me to continue several of our themes and conversations we've had here, a market structure expert, a head of research of market structure and technology at Coalition Greenwich. You're at Greenwich Associates, which is your company for over a decade that we talked, last was probably a few years back. So it's great to see you again, Kevin.
Yeah, great to see you too. Thanks for having me.
Tell me about what your main focus is at Coalition Greenwich right now from the market structure perspective, because I know you've got a wide range of things you can talk about. Tell me where we should be zooming in right now.
Yeah, so the market structure team at Coalition Greenwich, we really do run the gamut, everything from fixed income, equities, FX, derivatives, digital assets, of course, and all the infrastructure that powers all those markets. But yeah, I'm here mostly to talk about credit, fixed income markets, and sort of how that all plays in with derivatives and futures.
Okay. Yesterday, we talked about that very thing. iBox, David Litchfield from SIBO, and I thought it was a really interesting conversation because why not trade credit as a future?
Yeah, well, the story, it's actually a story that's been playing out since the global financial crisis, right? So we went through the crisis, there was new regulations on swaps, and the market thought, hey, everything's going to move to futures. Swaps are going to go away. Obviously, that didn't happen, right? So, but at the time, the idea was let's create a credit swap future, right? And that was the first try. I think the fatal flaw in the end was trying to get futures traders to trade swaps and swaps traders to trade futures. Neither of those folks want to do that thing, right? And so that product never really caught on at the time.
Interesting.
And
swaps people's more options people. Futures people kind of just technicians, price people,
Yeah, I mean, they're different worlds, and those products have different uses, especially at that time. And we'll have to go very quickly through a decade, but effectively that also drove the bond market to electronify, right? The dealers didn't have as much balance sheet to provide liquidity to the buy side, so the buy side needed to find another way to buy and sell their bonds. That ended up being through electronic platforms, right? And so electronic trading is now half of the investment grade bond market is traded electronically, about a third of high yield. I bring all that up because that is a big part of now why the newer breed of credit futures it does genuinely feel different this time.
It's built on a proper structure, basically.
Yeah.
Now it's fertile ground to have this type of contract.
Well, so ETFs really started to impact the bond market in the sort of late 2010s. There was some SEC rule changes, which maybe we don't need to get into. But so that arbitrage, trading ETFs versus bonds, that really accelerated. That brought in more systematic traders. That increased electronic trading.
You can narrow that gap even closer now?
So exactly. So now we have an ecosystem of systematic credit traders who would think futures great. And hey, options on futures also great, right? And we can bring that all into this ecosystem with everything tracking a similar group of indices.
Interesting. There's almost an analog where the retail person has, now they're slinging options more than they ever have. The institutional, now on the credit side, has their own kind of derivatives building up, on the bond side. So I guess in that market, then how do you think where are the stresses? If there's, this new style of trading in bonds, is that applying any pressure? Is the bond market just so huge, so liquid? But then you get into specific names too, right? That aren't that way. This isn't treasuries we're talking.
No, well, that's right. I mean, to be fair, even in treasuries, the couple of year off the runs, right? Even those don't trade that much, but you're right. Absolutely. In corporate bonds, there is very much a long tail of bonds that barely ever trade. But what I think is interesting is even in those cases, there have been innovative solutions that have made it so, an asset manager could electronically sort of gather quotes and trade illiquid bonds. There's ways to reduce information leakage. There's ways to decide which dealer's best to bring in on that trade, or maybe in some cases put that illiquid bond out to the whole market because that is the best way to get a price, which maybe will come from another asset manager.
The best way to find price is just to put it up for sale.
Yeah, there you go.
Okay, so it sounds like largely we can think about this as adding transparency to some extent, right? Kind of new ways. If you're a believer in capital markets generally and price discovery, then everything you're describing is kind of the equivalent of making like zero DTEs, basically.
Yeah.
Why not bring to the dailies effectively?
Yeah, I mean, if you're trading bonds against ETFs and then against futures, like that arbitrage amongst all of those products is what keeps prices tight and in line. And to your point, increasingly transparent, right? Futures markets do have that advantage of trading 24/7, and there's There's an order book, so you can always have that pre-trade price transparency. So it does add another element on top of, like I said, what's come from the ETF market, obviously, which is then all, I think, supporting the underlying bond market.
Okay, so when we've got a big move coming for the bond market, basically with cuts and the Fed, and how do you? I know that that's kind of a a short-term thing, but for those moments, it's a seminal moment. This one's really had a lot of drama leading up to it. How do you watch bonds to see kind of what their message is going to be over the next week?
Well, so I'll give you an interesting point. So when Powell was in Jackson Hole back in August, when you looked back at the volume data, you can see that credit ETF volume was up a little over 40% from the full month average, right? So there was a huge spike in trading volume in the ETFs, right? Because often if you want to quickly put on a macro position or get broad exposure, it's much faster to do it with an instrument like an ETF, and then, as we said, increasingly with a future, right? Rather than trying to trade the whole portfolio of bonds. Now, trading portfolios of bonds has also gotten a lot easier, but still not as quick as executing on an order book.
I'm kind of surprised then. I mean, look, I don't know the numbers necessarily, but it kind of seems like, and it's a part of the market that I hadn't really spent too much time thinking about, trading credit, and all the different facets. But I'm kind of surprised I don't hear more about the credit futures, to be honest. Am I imagining things?
No, I mean, I think
more institutions be using that.
They should. I mean, you can see the momentum is growing. The awareness is growing. We see that we did some research recently. We actually just published it just this week. But awareness was very high. So of the credit traders we interviewed, over 85% knew about the contracts, right? And that might not seem like a big deal, but in this case, I think it is. It's something people are just starting to learn about. And there is this catch-22 with any new contract where people want there to be liquidity before they trade them, but they need to trade them to make there be liquidity. But I think that snowball's starting. There's competition in the market, which also helps.
That's like the economic fission required for a market to work, right?
That's right.
When you hit that critical mass.
So
people, they want to see other people in there.
It is. Everybody knows it's a slow grind, but there just seems to be enough natural interest in this market. There's macro interest in credit markets are interesting right now, and then, like we said, just the systematic trading strategies that really could put use of futures.
I think the analog I'm going with for this is the way 0DTEs filled in, every little dot on the volatility kind of surface. The futures now are kind of filling in as well, that kind of full perspective on
I mean, if you're comparing to equities and 0DTE, we're probably still 10 years behind, but yes, the pieces of the pie are slowly being filled in. Much more so than they were 5 years ago, let alone 10 or 15 years ago.
Sounds healthy.
I think it really is. And, retail demand for bonds is growing as well. I think you can see it in some of the Fed data that retail investors are holding individual bonds right now, compared to holding just funds more than they have in a very, very long time. A lot of that comes from electronification. Separately managed account usage is growing, again, because the managers of those accounts can automate them. They can automate the execution. They can automate the rebalancing, right? So then they can offer those products with lower minimums. That also, all of that helps the bond market. That just brings more money into the underlying bonds, which makes them more liquid, which brings in more investors.
Great stuff. Kevin McPartland, nice. Giving us some really good color on market structure. Admittedly, too, something that even when we talked in the past, I felt that, I had limitations on how much I could visualize. But now after seeing, how a lot of these dots connect and studying the market structure in Chicago and on this show, that it becomes very fun. Good stuff, Kevin.
Great. Yeah. Thanks for having me.
Great perspective. Kevin McPartland, Coalition Greenwich.